One awful generalization in investment advice is the thumb rule that the amount of equity you need in your portfolio should be 100 minus your age. This assumes that the older you are, the lesser risk you should take. As the thumb rule goes, this may be an oversimplification. How much risk can you take is a function of two things: your ability and willingness. Risk appetite is about bearing losses in your investment. Willingness is measured by your attitude to loss. Whether you are worried sick or can take losses in your stride. Ability is about how much you can lose and still be solvent and financially fit. Elderly investors with accumulated wealth may be able to take risks. The loss in their investments may not make a big hole in the wealth they hold. But they may be unwilling to take risks, since they perceive that they may not have the time to make good for the losses. Young investors have the time on hand to make up for losses. They may be confident and willing to take risks. However, they have just begun to earn and may have limited accumulated wealth. They may also have loans to repay. Therefore, their ability to take losses to their capital might be limited. Risk appetite is the extent of loss of invested capital you can take without being devastated emotionally and financially. The 100 minus age formula for taking risk does not consider the other factors that may influence risk appetite. Risk appetite can be measured using risk profilers. These are psychometric questionnaires that try to assess your mental makeup towards risk. Along with the information about your accumulated wealth and income, they enable advisors to ascertain your risk profile. An investor unwilling to take more than 10% loss has a low risk appetite. An investor who is willing to take a 40% loss in his wealth has a high risk appetite. Investors with high net worth, higher education, knowledge of markets and investments tend to have higher risk appetite. Men have been known to have higher risk appetite than women. Age is one of the many factors. Younger investors take more risk. Each investor may have a unique combination of factors determining his risk appetite. Risk appetite of investors may not remain constant. With changes to age and family status, risk appetite can change. Changes to financial circumstances and experiences in investing can also alter risk appetite. An investor who has made a fortune in investing may be willing to take more risk, while the one who has just lost money may become more conservative. There are very wealthy investors unwilling to look beyond bank deposits and senior citizens who speculate on derivatives. The willingness to take risk is a personal choice and has to be backed by adequate financial ability.